Look at the skyline of London or New York. You were looking at trillions of dollars, pounds, and euros of accumulated capital. We are taught that this wealth is the result of innovation, free markets, and the Industrial Revolution. And that is true, but it is only half the story. If you want to understand why a banker on Wall Street earns in an hour what a cobalt miner in Congo earns in a year, you cannot just look at today's stock market tickers. You have to look at yesterday's shipping manifests. The modern global economy wasn't built on a level playing field. It was built on a slope, deliberately tilted to siphon value from the rest of the world into the pockets of Western powers. Welcome to Foreign Economics. Today we are auditing the books of the greatest wealth transfer in human history. To understand the present, we must go back to a time before free trade existed, before Adam Smith wrote The Wealth of Nations. The prevailing economic theory was mercantilism. Mercantilism was simple, brutal math. It viewed global wealth as a fixed pie. If England wanted a bigger slice, France had to have a smaller one. The goal of a nation was to export as much as possible, import as little as possible, and hoard gold and silver. But how do you maximize exports if nobody wants to buy your goods? You acquire captive markets. Colonies were not purely political ventures. They were economic assets designed for a singular purpose: to serve the mother country. The colony's job was twofold. First, provide cheap raw materials that the European power couldn't grow itself: sugar, tobacco, cotton. Second, serve as a captive market that was forced to buy expensive, finished manufactured goods back from Europe. This wasn't trade, it was a racket. It was a closed-loop system enforced by the Royal Navy and financed by the emerging banking houses of Amsterdam and the City of London. The most devastatingly efficient iteration of this system was the triangular trade. It is the blueprint for how early capital was accumulated in the West. Leg 1. Ships left ports like Liverpool, Bristol, or Nantes, loaded with manufactured goods, guns, cloth, and iron, heading for West Africa. Leg 2. The Middle Passage. The manufactured goods were traded for human beings. Millions of enslaved Africans were transported under horrific conditions to the Americas and the Caribbean to provide the free labor necessary to make the colonial system profitable. This is crucial. Capital requires labor to grow. By reducing the cost of labor to almost zero through enslavement, European planters and their financial backers in London realized astronomical profits. This wasn't just farming, it was industrial-scale extraction powered by human misery. Leg 3. The raw materials produced by enslaved labor shipped back to Europe to be processed into finished goods, restarting the cycle. Every rotation of this triangle deposited wealth in Europe and deposited devastation in Africa and the Americas. The capital accumulated from this trade funded the steam engines and factories of the Industrial Revolution. The Western industrial world wasn't built alongside the colonial world. It was built on top of it. But extraction was only half the strategy. The other half is often ignored: active deindustrialization. Before British colonization, India was an industrial powerhouse. Its textiles were the finest in the world, highly sought after globally. In 1750, India accounted for roughly a quarter of the world's industrial output. This terrified British manufacturers. They couldn't compete with Indian quality or price, so they didn't. They lobbied their government.
In Part 2, we show how that one decision still dictates global wealth today. Subscribe or you'll miss it.